Hello, everyone. Thank you for joining us today. Welcome to HUECU's Personal Finance Winter Session for 2023. We are so glad that you could join us for this year's topic, Financial Independence, Why Managing Your Finances Matter. I am Terrence Brazil, a Community Engagement Specialist at Harvard University Employees Credit Union. I am joined by my colleagues, Dominique Verger, who is also a Community Engagement Specialist, and Magdalia Gomez, who is the EVP of Community Engagement. To begin, HUECU is Harvard's not-for-profit financial institution committed to serving the Harvard community. The credit union is just like a bank, but better in almost every single way, including servicing all Harvard students, alumni, faculty, and staff with our wide range of products and services. Remember, once you join HUECU as a member, you are able to maintain membership for life. And your membership allows for your family members to join HUECU as well. International students are also eligible for membership. And to learn more, please visit us at huecu.org/international. Next up, we have a new branch located in the Longwood Medical Area. We are located at 435 Brooklyn Ave, right near Sweet Green. Come on in and stop by for a visit. We love when people pop in to say hi. As we keep going, we are glad to offer free financial wellness services to all, such as this session and many more throughout the year. If you hear anything during today's session and you wish to take action, please visit us at huecu.org/thrive, where you can get access to free financial counseling, as well as learn more about financial concepts, read blogs, and download some worksheets to take charge of your financial well-being in 2023. We are hiring. If you are interested in shaping what is next with HUECU, please consider joining our Student Advisory Council. On the council, you will consult on personal finance events and content, as well as projects on an as-needed basis. This is a paid position with flexible hours and open to all Harvard College students. No financial experience is required. To learn more, please visit us at huecu.org/SAC. Now, to ensure that we have the best Zoom experience possible, we have muted all of the audience members. Also, please submit any questions you have through the Q&A button on your screen. Feel free to submit these throughout the presentation and they will be answered by our presenter, Shahar. You can also submit these questions anonymously through the Q&A as well. Just check the box for anonymous before you send in some questions. Also, some great news, attendees are automatically entered into a raffle that will be drawn at the end of this in a couple weeks, and you'll be entered to win a swag box courtesy of HUECU. So, brief overview. For today's session, we will, at the end of today's session, we'll put a link to a survey in the chat, and we ask that you fill out the survey so we can continue making our personal finance sessions a success. So for today's second session, we have Shahar Ziv joining us. Okay. Shahar Ziv is the co-founder of the Harvard Personal Finance Management Winter Session course and is thrilled to be back to teach the program for the 12th year. He is a graduate of Cornell and Harvard Business School and currently works for PayPal as the Vice President of Strategic Initiatives and Operations. He is a contributing writer for Forbes and serves on the board of directors for the Harvard University Employees Credit Union. Please welcome Shahar and thank you for joining us today. Take it away.
Of course, I'm on mute. Thank you so much. And hi, everyone. Really great to be here. And thanks for taking time out of your day, especially on such a beautiful day to be here to talk about building wealth, which will be kind of an intro to investing. A couple quick housekeeping items. If you have questions, as Terrence mentioned, please use the Q&A feature. I will try to answer as many as we go through. We'll try to leave a few minutes at the end as well. Otherwise, you see my email on the screen. Feel free to send me a note afterwards if you have any follow-up questions, and I'm happy to answer or direct you to kind of other resources. So with that, let's get started. The only other thing I'll say is the slides will be made available to you. So obviously feel free to take as few or as many notes as you want, but you will have access to the slides so you can refer back. And I believe we're also recording this in case you want to refer back to the recording itself. So I'll give you a little bit of kind of an overview on really the question of why should you listen to me? And Terrence gave a little bit of the high level, but I'll give you a bit more detail. And frankly, I'll say it's why you should listen to me and not to TikTok. And I know there's a lot of financial advice out there, but here's a little bit of why this is probably a good source for you. So as was mentioned, one of the co-founders of this program, it's been, I think now 12 years, I need to update this. 12 years ago, I was across the river at the business school and worked in partnership with the credit union to start this program. I'm really, really passionate about kind of teaching students and early tenure employees about personal financial management. I do it at a lot of other schools, a lot of other employers. Just by way of kind of additional information, write about this, speak about it, and love teaching about it. Most importantly, though, is the bottom. I am as objective as you're going to find on these topics. I'm not affiliated with an investment firm, a hedge fund, any type of firm that is trying to kind of solicit your business. I'm not going to recommend any product or service for which I receive any type of external compensation for. So in short, I don't have conflicts of interest in the information that I'm giving you. And I say that both because I think it's important for you to know about me, but also as kind of a first lesson when it comes to personal finance altogether, and especially about investing. There are a lot of really, really good people out there who are trying to help you with your money. There's also people who have conflicts of interest and have other motives other than helping you grow your wealth. And it's really important to understand, why should I be listening to this person? Do they have any conflicts of interest? Is there any reason that I shouldn't be listening to to them? And so I call this out really importantly up front about me, but also just so as a kind of a first lesson. Somebody asked, do I give one-on-one advice? I generally try to kind of do kind of a one-to-many model. If there's like one or two kind of questions, definitely happy to entertain those by email and kind of give you some advice, or I would say guidance, and also refer you to some sources for more detail as well. So I always just like to start with that to highlight. So to set expectations, some of you may know one or both of the people on the screen. On the left is Warren Buffett, the founder and kind of the head of Berkshire Hathaway, one of the most prolific investment management firms out there. On the right is Melody Hobson. She's the CEO of Ariel Investments, one of the most successful investment management companies out there. We have 60 minutes today, and I can't turn you into either one of them. Investing is something that people spend their life studying. Instead, today is really going to be about giving you kind of your first tools in your investing toolbox. We'll really kind of focus on breadth. We won't be able to get into too much depth because of the time constraint, but I will give you not only some facts, but also some insights and basic strategies that will actually get you pretty far along in terms of setting up an investing plan. So just to kind of set expectations there. Now, look, I'm going to start by giving you the answer. And I know in class, usually you build up to this, you have an exam, you have to give the answer. I'm going to give you the answer up front. So the secret to investing, very simple. Well, it's not invest everything in GameStop, and it is certainly not invest everything in Bitcoin or FTX or any cryptocurrency. I would actually very strongly advise you to stay away from all of those. But the secret to investing is actually pretty simple. It's two words: be average. Now, look, I do a lot of these. I've done these at a lot of schools, and especially with Harvard students, this is probably the most counterintuitive thing that you will hear today and possibly even the entire semester. And I know we're only in January. My guess is nobody has ever told you to be average. Your parents didn't raise you and say, aim for mediocrity. If anything, you got to where you are by aiming to be and aspiring to be above average and at the very top. But here's the paradox. When it comes to investing, aiming for average will get you to be above average. Now, easy to say. Let me start to prove that to you a little bit. So I showed you Warren Buffett before. Warren Buffett's belief and what he espouses is that 99.9% of Americans should invest in what he calls average mutual funds. These are plain vanilla groups of stocks that really just aim to track the market. They don't aspire to beat the market. All they do is try to track the overall stock market. He was so confident in his advice around investing in average kind of stocks and mutual funds that he actually put up $1 million of his own money and said, I will bet $1 million of my money against anyone that my plain vanilla average investments will outperform whatever the counterparty wants to invest in. As you can imagine, I'm sure I've already been leading up to it. Not many people took him up on this, but one hedge fund, Protege Partners, did. The beauty of this is it was win-win. The loser would give $1 million to a charity of the winner's picking. So ultimately, the money was going to a good cause. But based on my kind of prelude there, you can imagine what happened. After 10 years, Warren Buffett, who had invested in the S&P 500, which is basically a plain vanilla mutual fund that really tracks the Standard & Poor's 500, which is one of the big kind of stock market indices, his average investment returned 125%. Protege Partners invested in 5 different hedge funds, had an average return of 36%. Not quite a quarter, but between a third and a quarter of what Warren Buffett had returned. Aiming for average gets you above average results. So, I can say it. This is a little bit more proof of that. And what I want to do is kind of take you through how to actually build what I would call an average portfolio, but essentially an average portfolio that has the likelihood of being above average in the long term. So look, investing is critical for many reasons. We are in kind of a weird time right now, and I'll talk about that in a little bit. But up until very recently, the average savings rate, interest rate at a credit union or a bank, was pretty low. Up until kind of late last year, probably got less than 1% and maybe even less than 0.1% on money you had in a savings account. Even bonds that are safer instruments had a very low return rate. And obviously the inflation rate a couple of years ago was less than 2%, now potentially in the 6, 7, 8% range. The only thing and the only instrument or kind of place where you could over time consistently really kind of grow your wealth was investing in the stock market. And you can see the average return of the S&P over essentially the last 100 some odd years at 8%. And so investing is critical if you want to grow your wealth. But there are, I would say safer, more disciplined ways of doing it. And there are riskier ways of doing it that can lead to potentially huge gains, but equally, if not more likely, huge losses. Just another example to kind of put some meat on the bones here. If you had invested $1,000 in the kind of stock market or in bonds in 1914 or 1915, if you had invested in bonds, you would have $3,000. Great, you tripled your money. But if you had invested that $1,000 in a kind of bundle of stocks, you would have over $2.3 million. Quite a big difference, and you would be a millionaire. So just to give a little bit more kind of theory behind this, I'll ask kind of a question, and feel free to chime in on the Q&A anonymously. Let's say you're walking down the street one day and you see a penny and you pick it up and you realize it's not just a regular penny, it's actually a magical penny. And the reason the penny is magical is because it doubles in value every single day. So on day 2, you have 2 cents, then 4 cents, 8 cents, 16, 32, 64, etc. How much money do you have on day 31? Any guesses? And again, you can do this anonymously. You're not getting graded on this. Give folks a second. Some people, hopefully nobody's opening up Excel or maybe trying to use your calculator. So I'll keep us moving just because we have a short amount of time. But the answer is $10.7 million. 1 penny in 31 days, or over the course of after day 31, you have $10.7 million. That's a huge growth rate. So number one, let's go back to my first observation around like why you should listen to it. Anybody that promises to double your money every single day or every single year, I would kind of throw a mountain of salt on that and really ask, do they have any conflicts? Is this real? Most likely it's too good to be true. Nobody has been able to consistently do that over time. And the only people who've, come close over a really long stretches, some of them have been, ones that have been accused of running Ponzi schemes. But that aside, one penny grows to 10.7 million. Now, imagine, you're walking, the first day you were walking down the street, you were too busy texting a friend, posting something on social media, you completely missed the penny and you only picked it up on day 2. If you only picked it up on day 2, at the end of the 31 days, you would have still a really nice amount of money, $5.3 million, but it's a lot less. It's actually exactly half of the 10.7 million. Finally, if you only picked up the penny on day 10, you'd have close to $21,000, which is a lot of money, but also nowhere near $5 or $10 million. So the reason I walk you through this, kind of conceptual example is to illustrate the title of the slide, which is the time value of money. Essentially, money, when it starts to kind of earn interest or rate of return, starts to grow exponentially. And this is something called the power of compound interest. And you can see that if you start on day 1, you actually end up with double the amount that you end up on day 2. Now, look, your money is doubling in these cases every single day. But look at what happens from an absolute dollar perspective. The really important doublings are what happen at the end. If you're going from day 5 to 6, yeah, your money's doubling, but you're earning 16 cents, or, in this case, from 9 to 10, you're earning $2.50. But when you get to the end, one more period of doubling, you go from 2.6 to 5 point, call it 4 or kind of $3 million, or from 5 million to $10 million. The last doublings are the most important from an absolute dollar perspective, but the only way to get there is to start early. And so in many cases, one of the things that I advise people is the earlier you can start to invest, and even if it's a little bit, the better off you will be in the future. And this is especially true when it comes to something which is probably on none of your radars, and it shouldn't be, which is saving for retirement. When you graduate and start working, ideally, the earlier you can start putting money away into your retirement account, the more you come closer to being kind of on day 1 of this and not on day 10. A question came in around how genuine the reference to returns over 50 years ago is, especially given that back then the US economy was developing and thinking about how it could compare to future returns. It's a great question. So look, historically, markets returned about 8%. If you survey economists, and there's actually a report from McKinsey, which did a really good job of kind of talking about this, there's belief that the average return in the stock market will be a bit lower going forward. Instead of 7 or 8%, it's predicted at anywhere between 5, 6, and 7%. And so you will have still, I would say, a healthy return, and most likely a return that is much higher than anything else that you will see in the market over the long term. But it may not be as high as it was historically. Now, at the same time, and we'll talk about this a little bit later, where you invest your money doesn't have to be just in the US. And there's a lot of research that says that a percentage of your portfolio, roughly 20 to 30%, should actually be investing outside the US in international economies, both developed and developing, as a way to diversify your money and also give you potentially a turbo boost in some areas on returns. So it's a great question. Nobody knows, but there are a lot of individuals who feel that the overall rate of return in the market will be a bit lower in the next 50, 100 years than it has been historically. So key takeaway number 1, just kind of file it away. Start saving early and save as consistently as you can. Now, I want to get into kind of some of the mechanics of investing. Before I do that, I just want to address what's been happening over the past, kind of couple months. You've probably, read the headlines. There's been increases in interest rates as a way to combat, kind of increases in inflation. The stock market has fallen over the past year, upwards of 20%. It's in what's called bear market territory. A lot of very influential individuals, including the CEO of JP Morgan Chase, Jamie Dimon, are foreseeing a recession. So a lot of pretty grim headlines. And if you think about it, a combination of high inflation, frankly, war, and rising interest rates leads to a lot of market volatility. And for a lot of you, this may be the first time that you're actually seeing or remember a significant drop in the stock market. Obviously there was a little bit of a dip in 2000 and 2008. You may have been following that, or you may have been too young to notice. But over the past 15 kind of years, it's been a pretty good time in the market. And so for a lot of people, seeing kind of this volatility is making them step back and say, whoa. Should I really be putting my money here? Am I going to lose it? There's a lot going on. What I want to do is show you how to construct a portfolio that will help withstand both short-term and long-term volatility and shocks. And so we're going to talk about a couple themes: saving versus investing, demystify some key terms, talk about the importance of aligning your risk level with your time horizon, making sure that all your goals are aligned with that strategy, and we'll really scratch the surface on whether you should do this alone or get help. So before you start to invest, which I know a lot of people, I think it's exciting, it's probably the sexiest kind of part of personal finance. Before you do that, I would have some recommendations. You need to start kind of saving first. And what do I mean by saving? You want to build up an emergency fund, kind of a stuff happens fund that gives you money in ideally kind of an account on the side to weather any financial shocks that come up. Ideally, the rule of thumb is to build an emergency fund over time. This doesn't have to happen within a day, a week, or a year. That gives you about 3 to 6 months of living expenses on the side. So if you for some reason later on lose your job, if for some reason there's a big housing expenditure, something breaks, your car breaks down, there's a big healthcare bill, you have the ability to pay that without resorting to high interest debt. Number 2, before you start investing, making sure that you are paying off your high interest debt, ideally double digits or high single digits, especially credit cards. If you go back, we talked historically, the stock market has returned 8% on average. The interest rate on credit cards, double digits, 11, 15, up to 24%, and could be even higher in some places. You are better off paying off that high interest debt than necessarily putting money into the market, just because you're essentially earning more. And then once you start working, I would say focus in on retirement contributions and potentially some kind of other approaches here. So questions came in, which I'll take here. How do we make an emergency fund if we don't really have living expenses, since you're college students? A lot of variety in terms of what each of you may be doing. I would say you have living expenses. They may be covered by, kind of a lot of different kind of things, but ideally, like, this is something that you'll carry forward, especially for when you start to work. In college, I think it's still helpful to have a small emergency fund. There may still be unexpected expenses. Maybe you need to travel home for something that comes up. Maybe there's, kind of anything, a lot of kind of different situations that could arise. But while I don't think it necessarily needs to be 3 to 6 months worth in college, I think it's still healthy to start kind of putting money away and having kind of that, kind of account just in case something does come up. Perfect. So a couple specifics here. I've been talking about different terms just because I know a lot of us may be coming from kind of different places. Just want to make sure everyone is aligned in some of the terminology that I'm using. So, checking savings account, many of you may have, kind of exposure to these. You put money in and essentially guaranteed and protected from losses up until pretty high amounts. And these could be, credit union checking account, an online savings bank. There are money market accounts. This could be a specific type of savings account. It could be what's known as a CD, or a certificate of deposit, which essentially locks your money in for a certain amount of time, but gives you a better kind of interest rate as a result. And then some things that we'll talk a lot about: bonds and stocks and mutual funds. So bonds are essentially an IOU from a company or a government to an individual, and essentially a loan that they then pay back. So if a company issues a bond, you may buy that bond. And then when the bond, after a certain amount of time, it could be a year, it could be 5 years, comes to maturity, that company will give you back the amount that you put in plus a certain amount of interest. There are other bonds that actually just give the interest over a course of time. Stocks, on the other hand, actually mean that you own a piece of the company. So if you own a share of Apple, you actually have a small piece of ownership in the company. And the way you make money with stocks is if the stock goes up over time, or some companies actually pay dividends, which is essentially, kind of like earning interest. Mutual funds are a collection of stocks or a collection of bonds. Instead of having to pick an individual stock or bond, which may be more risky, mutual funds try to, kind of diversify and put a little bit of many different types of stocks or many different types of bonds in at the same time. Somebody asked, are CDs better than stocks? It's hard to say if something is better or not. CDs are safer because the money, you're less likely to lose it. At the same time, the amount of that you're likely to earn is probably lower than what you would earn over the course of time with stocks. And so I'll give you kind of a framework for how to think about that in a moment. So the reason I talk about these different types of options is when you think about risk, you should think about each of these kind of options on a spectrum of essentially lower risk to higher risk. The lower risk means you're less likely to lose your money or lose part of your money. You're also less likely to make a lot of money on it. So checking a savings account, probably the safest place you could put your money, but you're also likely to earn less in interest. Bonds, stocks, mutual funds get riskier, and there's obviously gradients in between all of these. But stocks overall are riskier than bonds or a checking account. At the same time, they give you the option or the potential to earn more in the future. And by the way, this spectrum extends much further to the right. So things like crypto, I would say, are much riskier than individual stocks. Now, why is this important? Essentially, what you need to do is identify what it is that you're trying to invest or save for. What is the time horizon of that goal? And essentially, the shorter the time horizon, the less risk you should take, and therefore that's where kind of you should think about putting your money. The longer the time horizon, the more risk you can afford to take, and the more likely and the more you should necessarily be putting it into riskier items in the form of stocks or bonds or mutual funds. So for example, if you were telling me that you wanted to invest because in 2 years you're going to graduate school and you need money for tuition, I would tell you that time horizon is pretty short, and I would recommend veering more to the left of this spectrum. On the other hand, if you tell me that you're saving and you want to start saving for even though you just kind of graduated, you're about to start working and you want to save for retirement or build an investing portfolio for retirement, I would say your time horizon is really long, and you very much should be on that kind of right or further to the right end of that spectrum. So let me give you a couple examples of why risk and time horizon matter so much. If you had invested $1,000 in stocks over kind of the past 50, 100 years, and you were looking at the best 1 year return that happened over that time frame, you'd see that the best return was you could actually make over 50% return, and essentially you would have $1,500 in a year. But the worst year over the past 50, 100 years, you would actually lose a quarter or more of your money, and you'd only have $730. And so if you were saving for something in a year, let's say graduate school tuition or down payment on a house or anything else, and you had invested it all in stocks, you could either have a lot more, or you may not actually have enough to cover that. Here's another example though. Let's say you invested the same $1,000 and you looked historically over the past 1,500 years at the best and the worst 25-year period. So in other words, you looked at, let's say, like 1960 to 1985, 1970 to 1995, and you looked at all the 25-year combinations. The best 25-year combination, you would have made on average an annual return of 11%. That's really, really good. The worst 25-year time frame, you would make an average annual return of 8%. It's not as high as 11%, but it is much better than losing 27%. Represented another way graphically, this is the same data. You can see that in this is the 1 year, and this is the 25-year figure that I showed. So two things happen as the time horizon expands. One, the overall difference between the best and the worst possible outcome gets much, much smaller. You can see that in a 1 year time frame, the difference between best and worst is about 78, 79 percentage points. Over a 25-year time frame, the difference is 3 percentage points, give or take, 11 minus 8. So overall, the difference shrinks, and you can see that the worst possible outcome starts to get a lot better. Yes, in a 5-year time frame, you could still end up losing money, but once you kind of hit the 7, 8, or definitely 10-year mark, you're in positive territory. May not be great, but the further out you go, the more and more positive the best outcome is. And so again, the longer the time horizon, the more risk you can take, because you have a longer time period to kind of absorb any volatility that may happen in the shorter term. So let me just check really quickly. Perfect. Okay. So I bring this up because for a lot of people are thinking about individual stocks, kind of investing in very, sometimes high risk items. That may be appropriate for a very long time horizon. If you have a shorter time horizon, I would recommend a mix or kind of steering towards something less risky. I'll come back to kind of the building a specific portfolio in a minute, but one question that often comes up is, okay, you're telling me I should invest in, mutual funds and this and that. Like, where do I actually do that? Where do I go and open an account? There are a lot of different options. You can go to an investment management firm or a brokerage firm, the ones that you see kind of on the left of this screen. You can also work with robo-advisors, which have come up over the last decade, which essentially try to mimic the advice that a human financial advisor would offer at a much lower cost. There are a lot of really good investment management or brokerage firms out there. I can't give you a recommendation on a specific one. Two that I think, I would point you as good options: Vanguard and Fidelity. Fidelity, even a local, kind of Massachusetts company. These two are really big, reputable companies. They have a wide variety of investment options in terms of mutual funds and very, very low fees. And their mission is essentially to help people grow their wealth. There are a lot of other good options, like I said, even like a Charles Schwab, BlackRock, a lot of great options. The one that some of you may be familiar with, which I would, in some ways steer you away from, is Robinhood. And the reason I don't like Robinhood is they try, I think, a bit too much to gamify the experience, and also try to, in some ways, nudge or allow you to use very complex financial instruments, derivatives, options, etc., which I don't think are suited for the vast, vast majority of investors, myself included. And I think that there's a lot of temptation with Robinhood to put more money in and potentially put it in things where we don't all fully comprehend the risk. So that's the one just call out I would say on a Robinhood. Again, there are a lot of really great options. I can't recommend one, but highlighting a few that I think are worth considering. So if you are investing for the medium and the long term, my recommendation is to focus on mutual funds or something that's really, really similar called, and you may hear a lot about, called an exchange traded fund or an ETF. As we talked about with mutual funds, these bundle a lot of different stocks or bonds, which help diversify. They're convenient because you don't have to spend time researching individual companies. You don't have to think about buying and selling. And you can also get mutual funds for very, very low costs. Individual stocks, I think, are riskier. There are companies that oftentimes go bankrupt. You could lose your entire investment. They require more attention in terms of, when should I buy? Should I hold? Should I sell? My advice: the vast majority of your investing portfolio should focus in on mutual funds or ETFs. If you are inclined, and I think there's a human tendency to want to sometimes, play the stock market, Leave a small portion on the side for individual stocks, but I would say treat it as play money. Don't use that for a big portion of a retirement account or for money that you're going to need for any type of future, kind of activity, whether it's a down payment on a house, graduate school tuition, anything of that kind. How do you understand and what to look for in a mutual fund? Good mutual funds are low cost. For going back to what we started with, are in many ways average. Index funds that really just try to track the market, because they're passive, you don't have individuals who are picking individual stocks, which ends up costing more. So my recommendation with mutual funds, focus on very low cost index funds. Not as good are what's called actively managed funds, which have humans who are picking and trading individual stocks. Because of that, they have much higher costs, which you may hear something called an expense ratio, and generally kind of end up having much higher fees. Question often comes up, okay, they have higher fees, but don't they often generate better returns to make up for those fees? A lot of academic research says the simple answer is no. This is from one of my favorite New York Times articles. It's from back in 2014, cites a lot of research that basically looked at actively managed funds that were in the top quartile and looked at them from 2010 to 2014. And there were only 2 funds out of 2,800 plus that were in the top quartile each of those 5 years. And the conclusion from this, and backed up by a lot of other research, is this: very few funds consistently and persistently outperform the market. Moreover, what a lot of the research shows is that whichever funds are sometimes the best one year have a high likelihood of actually being the worst funds in the next year or the next couple of years. And so actively managed funds overall have a very hard time beating the market. Let me pause sharing for a second. I want to try to share a video. I wasn't able to do it with sound. Okay, I'm going to try this. If the sound doesn't work, Migdalia, Dominique, Terrence, just flag it for me. Sometimes, you hear it from me as one thing, but hearing from someone who's unequivocally funnier than me makes this hit home a little bit more. So let's watch a short clip.
Compound interest works both ways. Meaning, while your money adds up, your fees can really add up too.
Assume you're invested in a fund that is earning a gross annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. You've lost almost 2/3 of what you would have had.
2/3 of what you would have had is gone. So think of fees like termites. They're tiny, they're barely noticeable, and they can eat away your future. And one place where your 401k can be full of termites is the funds themselves. Generally speaking, you can choose between low-fee index funds, which basically just try to match the average returns of the stock market, or for a higher fee, you can get an actively managed fund with experts who will pick and choose stocks for you, trying to beat the market. And companies that sell active funds really believe in themselves.
At MFS Investment Management, we believe active management can protect capital long-term. Active management can take calculated risks. Active management can seek to outperform, because active investment management isn't reactive, it's active.
Okay. That's not so much a coherent commercial as it is a drinking game where you do a shot every time he says the word active. But the problem with active management is that even many Wall Street experts find it difficult to consistently beat the market. And there is sometimes embarrassing evidence of this, like when a group of professionals were pitted in a stock-picking challenge against a cat named Orlando.
Orlando's method, he throws a toy mouse at a grid of companies, very scientific. Last year, Orlando's picks returned nearly 11%, while the pros had gained just 3.5%.
So again, people sometimes are convinced from a variety of perspectives. Sometimes humor does it, but again, same concepts and same general guidance as what I gave. People sometimes ask about whether they should go it alone or use a human financial advisor. Again, we don't have time to go into too much depth, but there is one main point that I want to make. If you are going to use a human financial advisor or someone to kind of guide you, please remember this one word, and that word is fiduciary. Fiduciary is a legal term. A fiduciary means that somebody has a legal obligation, a legal duty of care to put your interests above theirs and above anything else. It doesn't eliminate conflicts of interest, but it is the best way of mitigating and minimizing conflicts of interest that may arise. So my strong recommendation is that if you want to use someone to help you manage your investments and help you kind of think through these, which I think can be very useful, please make sure that they are a fiduciary, that they are explicitly one, they will put that in writing, and that they sign up to put your interests first, which I think is the case that many of us want. Unfortunately, there are many individuals out there who are not held to this standard, held to a much less, I think, rigorous standard, and potentially have more conflicts of interest along the way. So that's just one piece of advice that I want to offer in terms of if you want to use a human financial advisor. If you put together a portfolio, and this kind of addresses a few of the questions, this is just what a sample portfolio might look like. This would be all in mutual funds or close to all. It would be 40% investing in mutual funds that are in large US companies, 20% in small US companies, and then 25% outside the US, both in developed and emerging economies. The point I want to make, though, is there is no right answer when it comes to what a portfolio might look like. There's many, and these are all I think pretty reputable kind of sources, many different ways, both in terms of like the number of items that you need in your portfolio and how to kind of think about them. Some, in A Random Walk Down Wall Street, which is a very famous book by Burton Malkiel, I'll come back to that at the end, says you can do it with 3 different investments in, one in a total US mutual fund, one looking internationally, and one in a real estate mutual fund. You can see others have, a much, kind of different breakout in looking at 6, 8, 10 different, kind of segments to break out the pie. What I want to say is, if you're looking for something more specific, I know I talked about Vanguard or Fidelity. Again, this is not specific advice. This is just a way to kind of make it a bit more practical. If you are looking to put together a very simple three fund portfolio, one way that you could do this is by focusing on 3 different mutual funds. One that was based on US stocks, one on international stocks, and one in bonds. And I gave actually the tickers, which, like a specific stock, mutual funds have, like in this case, a 5-digit ticker that you could use to essentially build this type of portfolio if you open up an account at Vanguard or Fidelity, and others would have the exact same thing. Again, in this case, this is from Vanguard. If you wanted to, you would go onto the Vanguard website, you would click on Open an Account. You would pick the type of investing account you were looking for. It could be retirement. It could be if you were trying to save for just general investing purposes. You would just click on that. They have a lot of other options as well. And then when you go in there, basically you would bring money in as cash, and then you would say, okay, I want to buy a certain amount of different mutual funds, and they would give you a list of those mutual funds. You'd be able to look at different characteristics there and make choices. And that's where, on Vanguard's side, you would be able to find these 3 mutual funds if you wanted to use those, or many, many others. So robo-advisors, I want to link this to kind of some of the conversation we've had. Robo-advisors essentially use artificial intelligence and machine learning to try to mimic the advice of human financial advisors and create automated portfolios for you. I think they're very useful for people who don't feel comfortable investing and managing their own portfolio, but may not want or be able to qualify for kind of the services of a human financial advisor. If you go onto a robo-advisor, you may see kind of something like this, which is starting out, they may say like, okay, what is your goal? What are you saving for? That goes back to something that we had talked about at the start in terms of kind of identifying kind of the goal that you have. And then you would also be asked to identify a target amount and what they call kind of term years, which is essentially the equivalent of a time horizon. And based on that, you would get a recommendation of how to split your portfolio. So I want to use this to kind of reinforce some of the concepts that we talked about risk, time horizon, and investment options. On the left, and this I used as Betterment, just Betterment, which is one of the robo-advisors, just for illustrative purposes. I created a goal called Safety Net, which is an emergency fund, and said, what if I want to save, $1,000 or $10,000 in 2 to 5 years? You can see that because it's a shorter time horizon, Betterment's recommendation was actually, the majority of the money being in, kind of cash or bonds, and only 40% in stocks, which are to the right of that spectrum. At the same time, I put in like bigger dollar amounts just to kind of make a point in longer time horizons. Let's say I wanted to save for a down payment and I wanted to save money for 5 years after I graduated. For 5 years, you can see that Betterment's recommendation is different. It's closer to a 50-50 split between stocks and bonds, and auto adjustment, meaning that as the 5 years gets closer, the portfolio would adjust to take on less risk. And it would do that by selling off some stock and essentially purchasing bonds. And then you could have something that's, on a longer time horizon. And, I talked about retirement as kind of probably the longest. Maybe one that, on top of mind for a lot of you at some point is, hey, you want to have kids, and maybe you want to be able to fund their education too. And so maybe you want to save for their college education. So maybe it's a 15, an 18 or 25 year time horizon. You can see that there, the recommendation is a much higher percentage starting out in stocks. And again, an auto adjustment, meaning that in this case, the term is 18 years. As it gets closer, maybe 15, 10, 5 years, this portfolio would automatically adjust to take on less risk. So somebody asked about taxes. So the way all this works in taxes is you basically pay taxes when you sell different financial instruments, whether they be mutual funds, stocks, or bonds, play in a similar way. So on taxes, the year in which you sell, let's take an individual stock, the year you sell that stock is the year that you might have to pay taxes on it. And the amount that you would pay in taxes, which would be based on what's called capital gains, which is the difference in price between when you bought and when you sold. If you sold for a gain, it would also depend on how long you held that stock. If you held it for less than 1 year, you would pay what's called short-term capital gains. If you held it for longer than a year, you would pay what's called long-term capital gains tax, which is at a lower rate. If you lost money on a stock, you would be able to use that loss to offset other income that you made to essentially lower your taxes. A strategy that's been used by many, many people kind of over the years. So again, I brought this in just to talk a little bit about how robo-advisors work, but also to reinforce and link to some of the other concepts that we talked about earlier. Given all of the volatility that you see right now and kind of this, my recommendation is that when you're investing, you take a little bit of a longer term approach. Focus in on setting up a solid plan that's based on low cost index funds. The best is, even if you can't buy a lot, a little bit at a time, kind of do a steady purchase of stock and bond-based funds that are fitting based on the percentage that you think is appropriate, and make sure that it is appropriately allocated based on your time horizon. That is, the best way that you can kind of reinforce putting together a portfolio that will withstand short and longer term shocks. If you are early in your career, which a lot of you are, the current downturn is actually an opportunity. The same way that, we just maybe finished up the holidays when, if you were going, to the mall or online and doing some shopping, you probably saw a lot of sales. The stock market, because it's down right now, in essence is on sale. In other words, you are able to get in and buy more shares or more mutual fund, kind of shares for an equivalent dollar amount. And so if you have a longer term time horizon, this is a great time to actually double down on putting money into your investing account, because you're essentially able to get more or better bang for your buck. It's also a great time to consider paying off any high interest debt if you have it, or consider some more opportunistic investments and savings options. Some of you may have heard about something called I bonds. They're basically tied to and try to cover inflation. They are returning a much higher rate right now. It's about 6.5%. Maybe something to consider. There are some constraints. If you sell before 5 years, you have to give up 3 months worth of interest. There's a lot of different kind of considerations, but something to consider about kind of juicing up your returns in a less risky way. Treasury bills, which are essentially the equivalent of bonds that the government issues, are actually returning a really nice healthy amount right now, 3-4%, partially because the Fed has raised interest rates so much. So that may be a good consideration as well if you're looking to park money for the short term with very, very low risk as well. Question came in around, is there a best day of the week to invest? I don't think there is one. I don't think we'll get to it, but I have some slides in the appendix on essentially trying to time the market and how that in essence backfires. It's really, really hard to kind of predict best day or, kind of when the market's going to turn. And so, it's hard. There's no real best day to do it. And dollar amounts, look, when you're in college, it probably is not going to be a lot. Anything is better than nothing. Even if you can do, $10, $25 a month or, every couple months going in, that at least is kind of developing that muscle and that habit of investing and starting to kind of get you into that routine. So all of you are probably in different circumstances. Some of you are maybe looking at, graduating with no debt. Some of you may have, other obligations, family obligations to be taking on. So it's hard to say and hard to put together, how much free money you have right now to be able to invest. And it's all going to be driven by that. On the I-bonds question, somebody just asked how long you have to wait to sell. You can sell pretty quickly, but if you sell before 5 years, you pay a little bit of a penalty in terms of interest. How do you buy bonds? You can buy bonds either through some of the websites that we've talked about, like a Vanguard or a Fidelity. Company issued bonds, sometimes you can buy directly from them, or through kind of even like government issued bonds, you can even buy directly from the government. I believe the website is treasurydirect.gov. I may be getting that wrong, but there are direct ways of actually buying bonds from the government. To link back to the taxes point, oftentimes when you buy bonds from the government, either at a federal or state level, they are exempt from some taxes, ideally, state or local taxes. So there are actual tax benefits to buying bonds. So I mentioned at the start this book which came out, which has been kind of stood the test of time, which is called A Random Walk Down Wall Street. Recently, one of my favorite New York Times columnists, Peter Coy, interviewed Burton Malkiel about this advice. And there's one quote in there that really stuck out to me, which is, "It is not often in life that the easy thing to do is the smart thing to do." And what Burton Malkiel was referring to was focusing in on low-cost index funds as a way of kind of creating your investment portfolio. So to go back to kind of the start, my recommendation to kind of create the foundation of your investing portfolio is to really focus in on those average, index funds that are very low cost. You can split them up between, US, international, stocks, bonds, many different ways of slicing it. But the more you focus on the core of your portfolio being, those types of instruments, as opposed to more speculative or, riskier ones, the more likely you are to end up essentially above average as you go through. So question came in around the best way to find out about buying tax efficient bonds. Let me actually go to some suggested resources to help answer that and some other questions. So as I mentioned, we're scratching the surface. Depending on your favorite medium of consuming information, these are some suggestions in the form of books, columns or websites, blogs, podcasts that you can learn more about some of these. I'll mention a couple on here. Just the founder of Vanguard was Jack Bogle. His kind of disciples or people who really follow his advice were called Bogleheads. and they've written a couple books around, the guide to investing. Erin Lowery, she's an author in her 20s, wrote a book called Broke Millennial and has a series which is aimed at, kind of very, kind of early stage, kind of grads looking at everything from budgeting to investing. I really like 3 different, New York Times columnists, Ron Lieber, Tara Siegel Bernard, and Carl Richards, which all write about different aspects, touch a lot on investing. Tara Siegel Bernard has written a couple columns about how to find a financial advisor, questions to ask. You can kind of look at kind of the archives there. I see some great, blogs out there, including Her Money or So Money, which is with Farnoosh Torabi. A lot of others on there as well. And then if you do want to work with a financial advisor, I can't give you a specific recommendation, but 2 places that I would recommend going. The XY Planning Network, which is focused on, which has advisors who are focused on serving, Gen X and Gen Y. And, I know, some of you may be later generations, but ideally these are advisors who are used to working with people in their, kind of early 20s and 30s. So ideally when you're graduating or, even earlier. The other one is NAPFA, which is the National Association of Personal Financial Advisors. What I love about both of these is every single person on there is a fiduciary. So at the very minimum, being able to work with someone from there. So there will be some kind of additional information in the appendix when the slides get sent out. I know this is kind of the 60-minute, Cliff's Notes version on investing. Again, we could fill an entire semester on this. In some ways, if you want, I believe John Campbell in the econ department has a semester-long course that's looking at personal finance and goes through some of investing and a lot of other topics in a lot more detail. He's fantastic. The seminar is fantastic. I've had the privilege of guest lecturing in there. So if you want, something with a bit more academic rigor as you go through for a longer period of time, I would look up his class and consider taking that over the course of your time. I will go back out to the first slide, and I know it was sent out in the chat, but just so you have my email address again, and it'll be in the slides that are sent out. We have a couple minutes. I will open it up. If there's any other questions that folks have, please feel free to type it in the Q&A, and we can look to address those.
Okay, and as questions are coming in, Shahar, I just want to personally say thank you. And on behalf of the HUECU team and everyone who attended, the session was phenomenal. It was extremely informative. And I don't know if I can speak for everybody, but I enjoyed this. This was very, very informative. I do invest on my free time, and I picked up a couple of tips and tricks here and there. And hearing you talk about it, this was great. Thank you so much for sharing.
Awesome. Really appreciate it. Thank you for having me, and thank you for the work that you and Dominique and Migdalia do. I think it's fantastic to have the resource there, and for all the participants. I sit on the board of the credit union, so this is slightly less objective, but still pretty objective. And I say that you have kind of a group at the credit union that is very invested, and pun intended, in helping students kind of with managing their finances. So it's a great resource. They do offer also, I think, in a variety of forms, more one-on-one counseling and different help. So appreciate that. And for the rest of you, best of luck with the rest of the semester and kind of the academic year. And please do reach out if you have any other questions.
Okay, thank you. We have a couple more in the chat. Do you want to answer these or want to leave them alone? What's your take?
I think I covered some. I think for the others, I would say if folks can email me more directly. I think they're a bit more niche in nature. So I would say those are probably best in kind of just an email exchange.
Okay. All right. Thank you, Shahar. Thank you so much for doing this, and thank you for joining us. Have a great rest of your day. And if you have any questions at all, please reach out to Shahar. Thank you. And I think that'll be it for us. All right. Have a good one. Bye, guys.